State, formerly called as Sundar Ventures Limited, Q4 and FY26 earning conference call. We sincerely appreciate your continued trust and support as we continue building one of India's most capital efficient healthcare platform, focusing on making healthcare affordable, accessible, and technology driven. Delighted to share it here that this year we successfully transitioned to the health X identity, reflecting our evaluation from a healthcare commerce business into a broader healthcare ecosystem, spanning pharmacy distribution, digital healthcare, technology, diagnostic, and preventive care. At HealthX, we are guided by four enduring principles that shape everything we do. Innovation powered by technology, value delivered with efficiency, impact driven by empathy, and trust built on authenticity. Our core values, being genuine and being child, are just not words on a wall. They are the cultural DNA of the organization. We ensure that every product and service we offer is 100% genuine, and like a child, we remain curious, non discriminatory, emotionally connected, and committed to growing every single day. Before diving into performance, we share a short brief on the company for the new participant added here. Many of you must be knowing we serve India through two powerful and complementary verticals as part of single business ecosystem. Sasasundar app or B2C platform connects consumers directly to genuine medicine, diagnostic, and wellness products. We offer real savings, counseling by trained health professionals, and AI-driven personalized care. Retail Shakti or B2B platform is designed to empower India's retail pharmacies. We give them better margins, complete stock availability, transparent pricing, and dedicated support, enabling them to serve their customers with greater efficiency and trust. Together, this platform form one integrated ecosystem unified by data, AI, and unrelenting commitment to authenticity. Technology remains central to our strategy. We operate through centralized technology-enabled fulfillment infrastructure with over 2 lakh square feet of warehousing capacity, more than double our earlier footprint. AI-led automation across procurement, warehousing, inventory management, and order fulfillment is helping us improve efficiency, accelerate delivery timeline, and create a scalable operating model capable of supporting significantly larger volumes. Coming specifically to FY26, which was indeed an important year for the company, a major strategic milestone during the year was the launch of Jitto, our own certified generic medicine category. Through Health Buddy and our extensive pharmacy network, Jitto aims to make high quality healthcare significantly more affordable by offering medicine at prices up to 60% lower than leading branded alternatives. We believe this initiative has the potential to become an important growth driver while further strengthening our mission of affordable healthcare. On the segment front, our B2B platform Retailer Shakti continues to emerge as one of the fastest growing pharmacy supply chain platform in India. Since financial year 2019, the business has compounded at nearly 78% CAGR and now serves over 62,000 retail pharmacies while partnering with more than 700 pharmaceutical companies. Our scale, technology infrastructure, and deep retailer relationship provide a strong foundation for sustainable long-term growth. On the customer side, our B2C platform, Sasasundar continue to demonstrate strong traction with improving customer engagement, repeat purchase, and operating efficiencies. Our B2C business remain highly capital efficient, supported by an inventory-light operating model and a working capital cycle of only 18 days, among the best in the industry. Looking ahead, our focus remain on these strategic priorities, accelerating the growth of Retailer Shakti, scaling our consumer healthcare platform, and expanding the Jitto ecosystem across product and healthcare services, while continuing our investment in technology, automation, and platform capabilities that we believe will drive operating leverage and profitability over the coming years. From uniqueness perspective, I would request you to pay your attention on the fact that we measure our capital efficiency by providing the cost of capital at the rate of 9%, and this scale of the business is built upon by total capital deployed, including the cost of capital, only rupees 259 crore. Our growth rate, total capital efficiency, consumer experience, technology stake, and governance is what we are proud of. We remain confident on our long-term vision and continue to target 6,000 crore of revenue by financial year 30, comprising 4,000 crore from B2B retailer Shakti and 2,000 crore from B2C operations by Sasta Sundar app, while progressively improving EBITDA margin and maintaining industry-leading working capital efficiency. As you are aware that our board of directors have approved a scheme of simplification of corporate structure. The details have been given in a detailed presentation filed with the stock exchange under the scheme. The finance division shall be demerged and listed separately in the name of Microsec Resources Limited. The existing shareholders will be allocated one equity share of the finance division against 3 equity shares held in the HealthX platform. There will not be any change in the existing shareholding of HealthX platform limited in the hands of existing shareholder. The public shareholder of such subsidiary system Health Body Limited shall be allocated shares of HealthX platform limited. The valuations are therefore is on the basis of mirror image. We would like to request you to visit our website HealthX platform for further information. With this, I would now request our CFO, Mr. Lokesh Agarwal, to take you through the detailed financial performance for Q4 and financial year ending 31st March 2026. Thank you.
Thanks, Nitarji. So, myself, Lokesh Agarwal, I will take you through
70,000 crore to equity and around 86,000 crore to corporate bonds.
There seems to be some background noise. I request participants to mute themselves first.
But the IPO pipeline of around 1.5 lakh crore
Mr. Dhyaneshwar,
remains
can you please
robust
mute yourself?
for the coming months.
Please go ahead, sir.
Okay. So, I take you through the financial performance of the company for the quarter and financial year ended March 26. So, during this quarter, we delivered another strong operating quarter, reflecting a healthy top-line growth and continuous improvement in our operational metrics. So, our revenue from operation increased to 356 CR for this quarter, a growth of 22% year-on-year and 4% quarter-on-quarter, driven by sustained growth across both the business verticals, that is B2B and B2C. Gross profit for the quarter increased by 45% year-on-year to rupees 26.5 CR, while gross margins improved to 7.3% as compared to 5.9% in the corresponding quarter of last year. This improvement reflects on account of better product mix as well as stronger procurement efficiency and operating excellence across our platform. EBITDA losses has reduced significantly to rupees 20 CR as compared to 29 CR of Q4 of FY25, representing an improvement of nearly 29% year-on-year, while EBITDA margin improved to negative 5.5% as compared to negative 10.3% in the corresponding quarter of last year. At PAT level, the quarter stood at rupees 12 CR as compared to a profit of 17.6 CR of Q4 FY25. The variation is primarily attributable to lower other income and exceptional items during this quarter. However, operational performance has been continued to improve with stronger gross profit generation and improving operating leverage across both the businesses. Further, you would notice that the full year FY26 financial performance has improved substantially. The company reported revenue from operation of 1,283 CR, reflecting a growth of 18% year-on-year, driven by steady performance across both our core business segments. Gross profit increased by 36.5% year-on-year to 96.5 CR, while gross margin improved by nearly 100 basis points to 7.5% from 6.5% of last year. EBITDA losses reduced significantly from 79 CR in FY25 to 65 CR in FY26, with EBITDA margin improving from negative 7.3% to negative 5%. Improvement in operational efficiency and disciplined cost management supported a sharp turnaround in profitability, with the company reporting a near PAT breakdown loss of negative 1.4 CR in FY26 as compared to a loss of 133 CR of FY25. From balance sheet point of view, we maintain a high capital efficiency, wherein our working capital is among the industry best. We maintain 18 days working capital efficiency, representing approximately 5% annual sales, while capital employed is roughly rupees 74 CR. We also have a cash balance of approximately rupees 30 CR. This does not include our treasury. This is purely cash and FD that is being held by us. So coming back to our working capital efficiency, which is 5% of our annual sales, wherein we still managed to cross rupees 1,300 CR in annual revenue. Overall, the performance reflects the company's continued focus on scaling revenue while improving operational efficiency. We remain committed to investing in technology, talent, and platform capabilities, which we believe will translate into stronger margin. Thank you. With this, I'll leave the floor open for queries.
I request the participants to please use the raise a hand feature for questions. Vedansha, please go ahead. Vedansha, you can please go ahead now. I think Vedansha is not available. We'll go with Praneeth. Praneeth, you can go ahead.
Hi, sir. Thank you for the opportunity. So I wanted to start with our Jito endeavor right now. So you mentioned that in our presentation that we have done with 15 and we have more in the pipeline. Could you explain how has the reaction been in the market and what kind of sales are they doing? And have you identified any challenges that you didn't expect when you were going forward with this plan?
So the Jito we have launched in both B2B and B2C platform. There is no negative surprises, rather there is positive surprises, and sales are going month to month.
Where we
This is
see
the
egregious violations.
This is the first quarter only. So the before the meaningful figures come in, we can discuss from the next quarter. So this quarter is the launching year. So in a few lakhs sales around say 30 lakhs per month we are doing. So it will take time to build up, but yes, the start is very good.
So this 30 lakhs, how is it split between the B2B versus the franchise model?
This is too early to discuss anything else. There is no meaningful conclusion can be drawn into this is the second month only. So I mean, but yes, if you want to divide it, then you can divide it. That 2/3 is coming from retailer Sakhi, 1/3 from Sasta Sundar.
Understood, sir. And one question is regarding our expansion beyond pharmacies itself, like hospitals and other final customers. So how are we on that endeavor, and are we not focusing? What is the situation there?
So the hospital business we are approaching them with our USP of emergency filling in next day. Otherwise, the hospital business, according to us, is not a very profitable. It's a credit driven business, and we avoid credit. So that is very highly capital intensive business. But yes, there is a very unique opportunity for us is to fill the stock when they need it, because we have the capacity of logistic and fulfillment center next day guarantee. So we are approaching all the hospitals to have our backup arrangement. They can take purchase from their regular suppliers, but when they are feeling that their stock is out, supply will take time. That is a very good space, and we think that 5-6% of their sales maybe purchases may be rotated to retailer Shakti. But yes, that's a good area. We have started in this quarter. let us see how this pan out.
Sir, are we planning on offering any credit, or would it be on the regular cash and carry basis only as we're doing right now,
No, we don't have any credit in our system. So whenever they are purchasing, they have to purchase cash and carry basis.
including for hospital channel also?
Anybody. I mean, this we discourage any type of credit because our business we are into platform business, and essentially we are not into credit business. We are not making a ecosystem which is based on credit.
Understood, sir. And coming to our AI consulting that we've already indicated in the last commentary, so could you explain what is the market readiness of this product and how much more time would it take to, let's say, scale up?
So this will take enough time because the consumers are not yet ready because 90% of our customers are not habituated to apply the AI, but we have to be ready because all of a sudden it will come as a matter of habit. So we have made the product for B2B called Retail AI, which will be automated filling centers for our customers in B2B segment and counseling tool in our B2C app. But we are treading very cautiously because any launching and market rollout need large amount of capital to be deployed in. And according to our study, the market is not yet ready. But we are ready. So we will wait for another 6 months before rollout. And once we think that market will respond, it will roll out in a slow fashion. Well, these are very good futuristic things, but before market is ready to roll out, need huge capital. And as I have said in my opening space, if you compare all the startup in India and what we built, the total capital deployed, including 9% cost on capital, is only 259 crore. So we are very, very capital conservative, and when we spend capital, we do it cautiously.
Understood, sir. But you mentioned the fact that we need to have some more like substantial capital that needs to be invested for it to take market ready, right? So how much more capital will we be investing over the last 6 months or a year into this consulting app?
No, we have assigned total investment in our tech stake, including our B2C platform, 150 crores. So already around 75 crores we deployed. To 75 more crores will be deployed. That's it. And by that way, our tech stake will be fully ready.
Understood, sir. And one question is regarding expanding beyond medicines itself for distribution. That's a surgicals and other things that some of our competitors doing. So how do we think about that? And are we in any pipeline to scale that business also, just beyond medicines?
Now we have already started offering surgical and devices in our retailer Sakti and uh, B2B retailers, then B2C session there. We have added nutraceutical category also. So as far as the pharmaceutical and wellness category is concerned, almost all are now available at both the platforms. Now we will expand to personal care and beauty care that we will do by next quarter. So by 31st December 2026, this will be roll out beauty care and personal care in our platforms.
But sir, let's say for now, what is the split between let's say medicines versus non-medicine revenue in the overall retailer Shakti split?
So non-medicine right now is very low. It's around 2% only, and we plan to make it by within a year to the extent of 10% of our sales.
Got it, sir. And our other expenses have shrunk considerably, despite considering the fact that we had like last time one-time experience or one-time expense of not getting a payment. So why has that been this year?
Can you repeat the questions?
I was asking what was the reason that our other expenses shrunk this year from last year?
Expenses increased.
Decreased. Our other expenses have decreased here.
No, other expenses have decreased primarily because of the our fulfillment center employees. So days earlier were they were outsourced. So now we have taken in our payroll. That is the prime reason of if you've seen there is an increase in employees expenses and decrease in other expenses. So those outsourced employees we have taken in our payroll to give them good experience of being employed properly, so that they have the loyalty towards company, and that is the reason.
So apart from the resilience of them staying with us, is there any other factor that for the change in strategy from contracting to making them in payroll?
The primary reason is that we want loyalty of them because of the large pool is a fulfillment center and logistic guy, and there is a huge competition from other e-com companies. So the key differentiating point we can make them for them is to give them a pride to work with Sasta Sundar ecosystem. So they can stay, and that has paid off very well, and our attrition rate is very, very significantly come down to very low. So now they work in our payroll, and they feel pride of part of the larger ecosystem.
Got it, sir. And in terms of cost, would this strategy increase it or decrease it? Like, how will it do in terms of cost, net basis?
Net basis, it remains same, but it does not make much difference because the outsource agency we give say 3 to 4% cost, but that we also incur in our internal administration. So net basis it remains same. It does not impact cost much.
Got it, sir. And in terms of, we had guidance by the end of the year, we'll turn Retail Shakti profitable and Health Buddy probably next year. So how are we in that journey? So in terms of break even, are we on track, or so what is the situation there?
No, we are on fully track. Retailer Shakti is running at almost at the break even, and both our business, I must explain that both Retailer Shakti and Sasandar's business are contribution margin positive. We recover the entire variable cost of fulfillment. And so the losses are coming primarily for our tech investments and our advertisement in building brand of Sasasundar and Jito. So both the business are kind of margin, contributing margin, and retailer Shakti is covering their corporate costs also. So yes, that has been achieved in the last quarter only.
Got it, sir. And last question is regarding our demerged business, Microsec. So what are the exact assets that are getting split between both? I understand that one business will remain for healthcare and the remaining financial arm and other things are going into Microsec. So could you just give a broad view on what assets are exactly being transferred? Because I think we wanted to merge Ingro also into it. So what exactly are the assets that are getting shifted to that company?
So the entire operating business, including treasury of Sasasundar Health Buddy Limited, that is the our material subsidiary company, will be merged into Sasasundar HealthX Platform Limited. So healthcare business will have both the business Sasasundar Retailer Shakti plus our treasury of around 400 crores as part of the core business treasury. And Microsec Resources will have asset base of around subject to actual calculation it will be around 140 crore rupees. Out of this 140, around 100 crore will be financial assets in terms of investments, and 40 crores are at the book value, are the real estate. So 140 crores will be the asset base of Microsec Resources Limited.
And this real estate, it is not for the Health Buddy, right? Is it, what real estate exactly is it?
No, it is not for Health Buddy, except that one real estate in Newtown, Calcutta has been rented to Health Buddy, so that Health Buddy will continue to pay the new company rent. Other than that, those are other surplus assets primarily for investment purpose that we plan to sell in due course.
Understood, sir. Thank you for your answers. I'll get back in queue.
Thank you, sir. Next question we have from Mooks. Mooks, please go ahead.
Hello, hi, good afternoon.
Good afternoon.
So, my first question, I'm actually new to the company, so pardon if it is a repetitive question or something. I wanted to understand that you said in the last question, you are keeping the majority of the treasury part in the company still with the operations, am I right? Some part of
Yes,
140 crores will be segregated.
majority treasury of around 400 crore rupees will remain in operating company, and around 100 crores will go to Microsec Resources.
Okay, so my question was, what is the reasoning behind doing this? Why are you separating 140 into separate companies instead of just selling it in the main company and then maybe returning the cash in some?
No, the treasury we will deploy in the business. The treasury is not a permanent treasury to remain it. As we grow, we need investments into our operating business. So we have clearly identified that this 400 crores we will invest into a next round of growth. So once we have a ambitious plan of 6,000 crore turnover by 2030, we will need to build additional fulfillment center that we have given in our presentation. There will be additional warehousing coming. There will be need of some working capital, and so yes, those will be. We have calculated that, and if after 3-4 years, if we found that there is an excess treasury, then we can return to the shareholders from both the companies in the same way. So keeping and then in operating company, because in 2 years there will be some losses. So treasury income get a benefit of taxation in the operating company. So in such a health, we don't need to pay tax on treasury income, while Microsec Resources treasury income is taxable. So shareholders has a good amount of tax of around 25% on the income. That is an added benefit of keeping treasury in operating company.
Understood. Got it. My question was on the lines that you are separating 140 crores of separate company, Microsec, if I'm not wrong. What is the reasoning behind demerging that company from this?
So the Microsec Resources after demerger will be listed separately, and the Microsec Resources Limited will issue shares to all the shares of HealthX Platform Limited, one share against 3 shares held by them.
I got that. I was asking about the reasoning behind the demerger. Why do we need to do that? If I'm not wrong, you said that you wanted to get majorly dispose of those assets, right? In that company.
Yes, so Microsec Resources, there are two parts. One is the corporate office of Microsec Resources itself, and one is the corporate office which has been given on rent to Sasal the health properties. So these two properties are used in the business. Others are few are rented, few are lands. Those are valuable properties. So we will sell that and will properly capitalize the Microsec Resources. So we hope to have a good amount of capital in Microsec Resources also.
Understood. On the treasury and investments part, so currently before the demerger, what would be the approximate value of the investments and treasury right now in the entire entity?
So entire HealthX Limited, there are around 500 crores treasury. 400 crores are lying in Sastasana Health Limited and 100 crores in Microsec Resources.
Right. And what would be the average yield that we have generated for FY26 approximately on the entire?
Sorry, can you repeat the question?
So I said that what is the approximate yield that we have generated on this
Okay,
entire
okay.
500 crores?
Okay, so yield is around, we have a very specific policy to generate yield between 10 to 12% per annum.
And how do we ensure that these amount that we are invested, which we are holding it for the long-term growth of the company, does not run into losses? So I was going through our investments, and there are some unquoted shares investments, as well as several of AIFs that we have invested in private credit institutions, and some of what is the policy there to ensure that those amounts does not result in loss or blocking of capital loss?
There is no capital loss. I am from investment banking background, so you must acknowledge the fact that we have built this company at a very, very low capital. And any capital efficiency business cannot be built upon by playing the state rules of within a framework of that we going to invest in government aids, government banks, and happy in 7%. So I myself has been an investment banker. We fully understand this return ratio, and by properly managing the risk, we can improve the yield from 7-8% to 10 to 12%. So there is a 4% gap. So on 500 crore, that 4% resulted to 20 crores, and that significantly offset the losses. So that we are doing from last so many years, and we don't find anything improper. So within 12% category also, we have a sufficient amount of surety, sufficient amount of security. And the unquoted shares which you are talking are also part of the structured deals. Those shares are only NSE shares. We made huge profit out of that also. And then there is a arrangement of structured out of that only. So don't invite it on, but you must appreciate the fact that by playing the template investing, we will make only 7 to 8%. And we are a startup company. We have rather than raising further capital from the investors, we have bought back the shares of Mitsubishi Corporation. So that amount of capital efficiency will not come by playing the typical template of managing investments. We are a business organizations. We take certain amount of risk by calculating risk in business operations. So to certain extent, a major risk we take in treasury management also, not a out of the way risk, but certain risk which we understand because we understand fully the treasury how it functions, and therefore we are managing prudently, and we have cut losses significantly by that.
Understood. Got it. My next question was actually on the lines of NSE IPO itself. So I was going through the balance sheet, and our approximate cost of acquisition is around 1600 rupees per share, while the listing is expected to be at considerable higher amount. What is the
Definitely,
approximate value I'm talking about?
NSE we will make around 15% per year annualized return.
Right. So I was calculating that we are going to net approximately around 95 to 100 crore rupees once we cash out, if we cash out of those shares. What is our plan on
We
those
are
shares? Are we going
getting
to
we are
sell
we
it?
are getting good amount of dividend also. So why not
Yes.
some part? I mean, 5-10% we can invest in such type of deals where we feel 100%. There is almost 90% surety of what we do, and
Right.
if we don't do the surety, then we have to settle for 6-7% return. That is not a good goal. By that, we measure ourselves cost of capital of 9%, whatever capital we deploy in the business. It is not a fun to deploy the capital and then wait for ROC. It is the fun not to deploy much capital and make a great company.
Correct. Totally agree. My next question was on the what is the current penetration in the Kolkata and West Bengal market?
Sorry, can you repeat the question, please?
What would be our approximate penetration in the West Bengal and the Kolkata market as of date?
You are asking Kolkata share of our business, right? Mush, you
No,
are
no,
not clearly audible.
no. I'm asking about the penetration of our company in the markets in the Kolkata and West Bengal.
West Bengal market share, we are having around 5-7% on different pockets, depending upon the pockets. So we command good market share.
Understood. So my question was on the lines that in the Kolkata and West Bengal being our home market, if we are able to command around 5 to 7% penetration, what is our strategy for the newer territories that we are getting into, like the Pur, Lucknow? So to increase our penetration much more faster.
Yes, so the Northeast we are growing by more than 50% year by year, and Northern India also we are growing by more than 25-30%, which growth is more than West Bengal growth. So our Northern operations are highly successful. In fact, we have to do the fulfillment center, double the capacity in Noida, and Northeast is also very highly successful. So both the geographies are increasing very rapidly, and we firmly believe that in next 2-3 years, those geographies will also command 5-7% market share without doubt.
Right. I got that part. So my question is the lines that what are we going to do from here on to increase our penetration more aggressively? What are the practices or what are the things that we are doing for that, except for the bigger facility and more faster? If you are
The
following.
penetration we can penetrate from the same infrastructure. Like, from West Bengal, we started penetrating in Odisha, Bihar, and Jharkhand from here. And from northern Noida warehouse, we are getting to UP. Now, Lucknow, we are started building differently. And then entire NCR and Rajasthan, Haryana, those geography we already supply. From northeast, from Assam, we supply to entire northeast. So there is no issue at all. But now we are planning further and further going deep. We are also planning to build 10,000 square feet smaller warehouse to have the rapid filling in nearby towns also. So we are moving one by one, not in a hurry. We are making very cautious decision in everything what we do, and happy the way the company is growing with a cautious approach. And so the growth is coming with a discipline that you can appreciate in our spending and investing.
Right, got it. My last question was on the lines that the new fulfillment centers of Lucknow, Udaipur, and Patna, they are approximately 2.5 lakh square feet of space. What was the approximate capex that went into them, and what was the time that it took for us to go live?
So we are building Udaipur, Lucknow, Patna, Guwahati, and additional warehouse in West Bengal. So the total capex we have planned of 234 crores. Out of that, 154 we plan to take the bank loans, and around 100 crores we plan to deploy from the treasury.
Okay, got it. Thank you very much.
Thank you.
That's it.
Thank you. Next question we have from Vilina Jain. Vilina, please go ahead.
Yes, hi, sir. So firstly, want to understand from the fulfillment centers which we have, we recently expanded our capacity. So from the current warehousing and the fulfillment centers which we have, what revenue scale can we achieve? Like the 6,000 crore top line which we are targeting, can we achieve it from our current base?
The current pace from current three warehouses,
Yes.
6,000 crores is difficult. So therefore, we are building another warehouse, Udaipur, Lucknow, Patna, and additional warehouse in West Bengal. So we are already started building this warehouse capacity, and we need additional warehouse in Barekpur definitely, or Noida warehouse. We are making capacity double. So around September, we will shift to the new warehouse, which is double than the existing capacity. And we have already planned for 6,000 crore revenue. So by including this new capacity, we will be sufficient to service 6,000 crore revenue.
Okay. And so what would be the capex that we will be doing for the expansion?
The total capex, as I have said earlier, uh, will be 424 crores.
424 crores. Got it. Secondly, sir, you mentioned that we are already contribution margin positive for both our retailer Shakti and Health Buddy business. Would it be possible to share what percentage margins we are doing there? And what is the gap between the contribution, what is the cost between the contribution margin and operating margin that is leading to negative EBITDA for us right now?
So we are making the system of that MIS. Probably from the next quarter, we will disclose to the stock exchange the rollout of the contribution margin vis-a-vis fixed cost. Right now, those informations these are the proprietary tech capabilities. So we don't want to move ahead to disclose to take public to those informations. So from the next quarter, we will be probably able to disclose contribution margin and take cost separately.
Okay. So, sir, with the scale, like as we reach 6,000 crores top line, as we move towards it, what is the peak operating margins that we can do, like when the leverage starts kicking in?
So at 6,000 crores, we estimate that our EBITDA should be around 5%, and our PAT and cash flow should be 4% of the revenue. So that is the estimate we are having.
Okay. Um, and you already mentioned with respect to Jito, sir, you did mention that it is relatively newer, but what are our targets with the Jito expansion in terms of revenue and margins?
The margins are very heavy because of the fact that these are private label brands. So margin will range from 30 to 40% gross margin. And because this is a private level, so it will take certain amount of time before we build up. So we have started, and the initial response is very, very good, more than what we expected. But let it build up. I think from the third to fourth quarter, we'll be able to tell you how it will pan out. Because it is too early to comment upon that.
Okay. All right. Thank you, sir.
Thank you.
Thank you. Next question we have from Harshit Khadka. Please go ahead.
Thank you for the opportunity. Am I audible?
Yes, yes, you are audible, Arshit.
Yes, sir. Thank you. So just wanted to understand what ROE are we targeting for next 2 years for FY27 and 28?
27, 28 ROE is not much because 27, 28 there may be some negative profits. But for 29, 30, the ROE will be very significantly higher. And we are building a business of around 40% ROE going forward once we achieve the scale.
So any broad range for 29 then?
Yes, 29, we should be making around 3% of the revenue as a profit. So, say in that year, we remain at 4,500 around. So, 3% will be around how much it will be?
120.
120 crores. But the capital deployed will be hardly 300, 400 crores. So again, ROE will be very, very high.
All right, sir. Understood. Thank you.
Thank you. Next question we have from Darya Trivedi. Sir, please go ahead.
Audible?
Yes, yes, Darya.
Yes, sir. Yes.
Yeah. So given that, our new warehouses are going to be operational in the current financial year, what revenues are we targeting from Retailer Shakti in FY27?
FY27, we don't give the year by year guidance because it's very difficult in our business. There may be some quarter to quarter difference, but June quarter, I think that because since we have my April, May figure, so June quarter we must be ending around 400 crores. And June quarter, we expect that it will be the best quarter in the company's history in the in the Flipkart arena in year 23-24 when we had the partnership with Flipkart. In Q3 we had the highest turnover of 374 crores. So the current quarter we estimate to close around 400 crores revenue, and that is the best quarter in the history of the company, and that you can stipulate it by giving some growth to the yearly revenue. But as I said, that we are in the building space, we are a startup company, so there will be some quarterly variance. It does not go linear. But definitely, we hope to have a good year by looking to the figure of April, May, and June. This is already 12th June, and we are comfortable to cross 400 crores revenue in this quarter.
Right. So if you just annualize that for 4 quarters, and given the fact that we are going to be operationalizing the new warehouse, so if all goes well, we should be north of say 1700 odd crores for Retailer Shakti in FY27, right?
That you can stipulate, but not a guidance from me because uh, some quarters may vary. But I can say that it will be the best year in the history of the company, and both from revenue side and from Jito's margin expansion, and both from operating leverage. And I am pretty sure that we will build a very good company and will be able to showcase in this year. And we are very excited. We have taken a lot amount of innovative initiative last year, and that those are resulting a good amount of result in this year. So by Jito, by Retailer Shakti, by three good additional warehouse capabilities, the April, May, June's results are showing good potentiality both in terms of sales and profitability. And we hope to do a good year. Yes.
Right. And how much, EBITDA margin we are sticking to our earlier guidance of, 1% for the entire financial year for Retailer
Retailer
Shakti?
Shakti, yes, Retailer Shakti, yes, that is true.
Okay. And what's the additional square feet of warehousing space that will go live this year?
So live additional square feet in this year by end of 31st March, it will be around 1 lakh square feet only.
1 lakh additional, right?
Yes, yes.
Okay. And the current capacity would be how much?
2.5 lakh.
2.5 lakh is the current capacity. By 31st March 27, we will have added by 1 lakh capacity, and we will start making another 4 lakhs. So that will take year by year additional capacity. So we will take action to build 5.52 lakhs additional warehouse capacity into Udaipur, Lucknow, Patna, Guwahati, and Barepur additional warehouse. So total capacity will be more than 8 lakhs, more than 8 lakh square feet.
Right. And earlier we had given, very aggressive guidance for, even Sasta Sundar. So, I mean, how are things progressing on that front?
The system is doing very well, and we hope to meet the guidelines.
Okay, because this year the growth was rather muted. I mean, we didn't see too much of growth in FY26.
That is, I'm telling you, you need to see from my angle. So please don't see quarter to quarter. So if you see, we measure the company by quarter because last quarter we transform our health store into Jito store, and that transition takes certain amount of disturbance in sales of branded medicine. That happened with every model. But if you take by this year end, because the time for growth has started again coming. So the quarter to quarter, because or is not a linear company. You please see our company as a startup company only. When we are in a very infancy stage, we will experiment certain things. We will apply technology and then scale. We may be slow in one quarter, next quarter, because there are only two ways of learning. Either we deploy huge capital and take the risk of losses, more losses, or we become a capital efficient and choose to go slow in the experimental stage. So we opt for second option. So the learning comes at a very negligible cost. And that is the beauty of if you see that this type of company, the current year, if I can say that if I stipulate even 1600 crore, 1700 crore revenue company with profitability, clear profitability, that is built only by 250 crores. If you compare this with other startup companies, then you can see the massive difference.
Right, understood. All right, thank you, sir. Thanks a lot.
Thank you. Next question we have from Preet Shah. Please go ahead.
Yeah, Mithal sir. Yeah, many thanks for. I am good, sir. I am good. Are you? Am I audible clearly?
Yes, Faith, you are audible.
Yes.
So, Mithal sir, many thanks for taking the first step for simplifying the company, which we have been trying since many years. So now this is a good starting point for us as an investor. So my question is, how do we expect Microsec to be valued post listing? Like what AUM and earning base should investors underwrite?
Microsoft researcher, you must take the value of as per the book value. Tangible assets are 140 crores revenue asset basis. So that you can expect right now, and then post that depends upon the listing. But today the valuation can only be measured by the book value. So the book value of Microsoft Resources is estimated to be around 140 crores.
Okay, perfect, sir. And how about the AUM, like that company handles? Is it something that you can share at this stage of time?
There is no much AUM that company AUM. You must be talking about the PMS license. So that is not active. That we are carrying that maybe that has certain background, but that business was long sold in 2016 only. So that is the license only. So there is no AUM as such, but yes, there is a treasury of 100 crore of financial assets and around 40 crores of the real estate at book value. So that is 140 crore is the asset valuation, and based upon that you can take a call.
Okay. And Mithal sir, last question. So, do you have any aggressive plan for Microsec? Because you and Ravikant sir coming from like a hardcore equity investment kind of a background. So, do you have any aggressive plan for Microsec post listing, like to revive that as a active AUM or NBFC sort of a company, or your focus will only be on healthcare?
Preet, I mean the healthcare opportunity in such the retailer sector, health tech taken together is so massive that we don't want to dilute my mind or Ravi's mind anywhere else. So, from my perspective, I will fully focus on HealthX Platform Limited. But yes, the financial service is also a great business, and yes, I have interest. I have certain hobbies. My heart lies in financial service also. But we will look certain amount of partnership, maybe with some team, some people's team. But that we will look only after this year, because this year we have a ambitious plan of our AI applications. We have the ambitious plan of our growth uptake. We are building new warehouses. So there are so many initiatives Jito we have launched, and building Jito's network that we have to make it successful. So there are so many things on the agenda. Another agenda will dilute our management bandwidth. So your answer is no. Right now we don't have any plans for financial services. We want to fully remain focused on HealthX business. But we will look into after 31st March 2027, once the demerger process is complete, that how can we do so. And if we are not able to do so, then either we get it delisted or we merge this company into another financial service company. But we will not keep the shareholders by value or worth into a deadlock position where those are held up in a slow moving holding company. That structure we don't like, and we don't want to do that, and we don't intend to do this. Either we partner with some people as a team, or we get good exit for the shareholders. That is what our intention is.
Yeah, many thanks, sir, for sharing this insight. Yeah, and all the best. And yeah, we are very much excited and see how we are building the company and bringing impact to the healthcare industry as a overall. Thanks, sir.
No, Preet, you have been always supporting us and we value your contribution. And I firmly believe that we are building a great company in India and people will remember this building. And I mean, apart from solving a bigger issue in the society, this will yield a massive economic value addition to the shareholders also. So we hope to do
No, no,
great things.
sir, we have full confidence, and like the way company grew from 20 CR or 50 odd number of CR 10 year back, all the way to today 1400 CR is commendable achievement under your leadership. And now the way AI is shaping around and the proactively companies investing in this AI platform, that is also like we are very excited to see. So yeah, we are very confident, sir. And thanks for all your hard
I
work.
would like to, I would like to mention very important factor that while the others are building their company by purchasing the revenue and deploying the capital, we sold our revenue, we recapitalized the company and then building it. And rather than raising fresh capital, we bought back the shares of Mitsubishi Corporation. That is how this company has exemplified the capital efficiency apart from innovation.
Completely agree, sir. Like most of the people are like our the competitor. They are also like they are not considering the rate of debt into all the calculation, which we are from day one focusing on the patient capital cycle. So that is something, yeah, very interesting to see. And like at least we are very confident, sir. And the way like you are so proactive and sharing all the insights to young generation and all will always like you are the leader for us, and definitely we are learning many things from you. So thanks, sir,
Thank
for
you.
this.
Thank you. This was the last question for the call. And thank you for the participation. And now I request the management to give their closing remarks.
So thank you guys. Hope to travel together for building one of the great companies in India. We are a startup company with a great vision. So please go through our website healthxplatform.com and send me your suggestion that how can we improve the shareholders information in a better manner. My mail ID is blvittal@sastasundar.com. Thank you so much.
Thanks, everyone.
Thanks all.
Thank you. Thank you.
Yes, ma'am.